Hello, traders. Gary Wagner here. It is 11:50 in Honolulu, 5:50 in New York on Tuesday, 21st day of March, 2023, and this is the Daily Report for gold and silver. There were a couple of events that led to today's sharp decline in gold of $40. First was the FOMC meeting. It began today, and there is an 80% probability, according to the CME's FedWatch tool, that tomorrow they will have a smaller rate hike of 0.25% or 25 basis points. Secondly, it seems as though market sentiment is shifting for genuine and dire concern about these bank failures that occurred in the United States, along with Credit Suisse, to an easing of concern as these crises seem to be working themselves out. After Friday's incredible upside move, yesterday's price high at $2,014 and the inability for it to sustain that price above $2,000, and today's strong sell-off of $39 creates a basic three-day candlestick pattern called a three-river evening star. More on that in a little bit. But gold today did close lower by 1.98%, with the most active April contract fixed at $1,943.60. That was accomplished with a very neutral dollar. The dollar itself was down by 0.08%, and the index is currently fixed at 102.855. Lastly, silver declined by 0.56%, and we currently have silver futures at $22.52. If you recall from yesterday's show, or if you looked at the chart that I submitted for my Kitco column after hours, it contained this image without today's candlestick. In other words, a down arrow and a question mark. The reason that I put that there is that we had that extreme high of $2,014, a tremendous range, but we had a red body candle that was very small, in other words, a doji-like candle, and because it gapped above the closing price of Friday, we could label it as a star in the evening position. To label that correctly, the first thing that we have to address is that the market is in a defined, or was in a defined uptrend, I should say. And you get this large green candle, a star or doji that gaps above the real body. And then the following day, today, if you get a long red candle with the opening price, which is right here, that is below the real body of the star, we can correctly identify that as a three-river evening star. However, to properly identify that candle, and we can't really determine that till today's action, the following candlestick needs to be what's called a confirming candle. And a confirming candle needs to be a large red candle, or a red candle, the larger the better, I should say, that has a lower high, lower low, and lower close than today's candle. If that's how we see tomorrow's activity unfold, and realize that tomorrow the FOMC meeting will conclude and they will announce a rate hike, which we're all expecting to be 25 basis points, which is pretty much factored into the market, we could see a continuation of the selling pressure. If that's the case, what technical price points would be of interest? And in order to answer that question, I have created a basic Fibonacci retracement from this current leg, the beginning of what I believe to be the first part of a fifth wave. It begins at approximately $1,812. It concludes at $2,014. The first price point that would be significant would be the 38.2% retracement. That occurs at $1,937, which is very close to the low of the day. Below that, there is the 50% retracement. That occurs at roughly $1,914, and an extremely deep correction could take gold as low as a 61.8% fib retracement. While I always negate the very deep retracement, meaning that it would break back below $1,890, theoretically it is possible. Personally, I believe it is the least likely of the three. I'm going to kind of look at this middle ground past the 38.2% retracement and above the 61.8% retracement, which means that I would like to see, if we get a continuation of selling pressure, how gold prices react at $1,914. We'll get more information when the Fed makes an announcement, and we see if market sentiment, which has definitely eased concerning the banking crisis, continues to diminish. What is really important to me is that after this long run, it finally gives us the opportunity to re-enter the market from the long side, which would necessitate a price correction. Before we thought that that would be the best action. Although we took about $7,000 per COMEX contract out of the last trade, as I said a few weeks ago, this final fifth wave should present multiple opportunities to make effective trades. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.